Let's look at the data. Right now, we are seeing a massive market divergence. You've got clear economic pressure points flashing warning signs, but at the same time, you've got this one stock that seems to be completely defying the laws of financial gravity. So today, we're going to deconstruct this market anomaly and figure out what is really going on.
Okay, the heart of this whole thing, the real puzzle, is the absolutely staggering valuation of Trump Media, ticker DJT. And look, this isn't just your typical overvaluation. No, this is a statistical outlier so extreme that it makes you question the very metrics we use to define value in the first place. So the data from FactSet it's crystal clear. The company is trading at 1,240 times its annual revenues. Just let that sink in for a second. 1,240 times. A hot, high-growth tech stock might be considered expensive at 10, maybe 20 times revenue. This valuation isn't just on another level, it's playing a completely different sport in a different galaxy.
Right. And when you see a multiple this insane, it's a huge red flag that traditional financial metrics, they've been thrown out the window. They are no longer driving the bus here. The price is being dictated by something else entirely. A narrative, a belief, maybe even a political movement. And that is the anomaly we really have to unpack. For any social media company, its value is supposed to be tied to its user base, right? Well, the data here shows a massive disconnect. You can see Truth Social has about 1 million monthly users here in the US. Compare that to X, which has 70 million. The daily user gap, it's even wider. This huge gap between the user numbers and the market cap is a critical warning sign for anyone doing fundamental analysis. And this, right here, just illustrates that disconnect perfectly. The company's own filings show revenue is under $1 million for the quarter, and it's actually declining. Meanwhile, they lost almost $55 million with legal fees eating up a huge chunk of that. The fundamentals, they just don't support the valuation. It's not even close. So when you have this kind of fundamental disconnect, it leads to let's just say, some pretty blunt assessments from people watching the market. One commenter from our source material put it this way, quote, "Just another greater fool crypto scam." Now, that perspective frames the stock not as an investment in a real business, but as a purely speculative game based on the greater fool theory, where the only way you make money is by finding someone else, a greater fool, who's willing to pay an even crazier price. All right, let's zoom out now and look at the macro picture, because this wild stock story isn't happening in a bubble. It's playing out against the backdrop of a seriously stressed economy, which honestly just makes its valuation even more of a head-scratcher. The latest labor market data is, well, it's not pretty. The combined total of people on continued unemployment claims and those who've been out of work long-term has hit nearly 3.7 million. That's the toughest unemployment situation we've seen since late 2021. It's a clear signal that the underlying economic engine is starting to sputter. And here's where that data hits the real world. This quote from a small business owner in Utah just says it all. He's had to finance almost $1 million in unexpected tariff costs. Think about that. He's not working for profit anymore. He says he's just working to pay off that debt. And these stories just show how widespread the disruption is. You've got a music store in Georgia that can't get instruments for school kids, an importer whose shipment gets destroyed at the border because of all the confusion. These aren't just numbers on a page. These tariffs are creating real chaos in the supply chain, and they are absolutely hammering small businesses. So on top of all that underlying economic stress, there's a huge policy debate brewing in Washington that could inject even more uncertainty and volatility into the whole system. The proposal on the table is to completely change how Obamacare's subsidies work. So instead of sending billions of dollars to insurance companies, the idea is to send that cash directly to the people. This would be a massive, seismic shift in policy. Okay, so analysts looking at this immediately draw a line to another big idea, universal basic income, or UBI. So why are they making that connection? Well, it comes down to one simple word, fungible. Money is fungible. Once that cash is in your hand, you can spend it on anything, not just healthcare. So critics see this proposal as a potential Trojan horse for a much bigger program of direct government payments. So the heart of the critique is really this slippery slope argument. It all starts with that principle that money is fungible. From there, the critics argue that the program would inevitably expand, and before you know it, you have this permanent and incredibly expensive new line item in the federal budget. So we've got a stock driven by narrative, a weakening economy, and massive policy uncertainty. How in the world does a trader navigate an environment like this?
Well, the answer might have less to do with the data and more to do with psychology. Let's look at some insights from the investor Morgan Housel. Housel makes this brilliant point that building wealth and keeping it are two totally different and often opposite skills. Getting rich requires you to be optimistic, to take bold risks. But staying rich, that requires the exact opposite. You need a little bit of paranoia, a conservative mindset, and a laser focus on just surviving. And the ultimate case study for this is the Vanderbilt family. Cornelius Vanderbilt built one of the biggest fortunes in history. His heirs? They were masters at spending money, but they had absolutely zero skill when it came to staying rich. They were so busy trying to one-up each other that within just a few generations, that enormous fortune was gone. A perfect, tragic example of failing to make that crucial psychological shift. This quote from the legendary trader Ed Seykota just drives the whole psychological point home. His idea was that traders who lose all the time might actually subconsciously want to lose. Maybe they're seeking the drama or the weird comfort of failure. It's this powerful idea that what happens in the market often reflects our deepest psychological drivers, not just our fancy charts and analysis. Okay, let's tie this all together. We've looked at the insane valuation of DJT, the real-world economic pain that people are feeling, the unpredictable policy shifts coming out of Washington, and the complex psychology that drives all of us. So what does it all mean? What we're witnessing here is a collision of forces. The market is basically a battlefield between cold hard numbers on one side and powerful, compelling narratives on the other. And right now, for certain assets like DJT, the narrative is clearly winning. The story is just more powerful than the spreadsheet. And that really leaves us with the central conflict for every single trader in this market today. Are you trading the numbers, the revenue, the profits, the cash flow, or are you trading the narrative, the belief, the influence, the story? In this kind of environment, figuring out which one of those forces is actually in control, well, that's everything. Just a reminder, this analysis is for educational purposes only. Market data changes incredibly fast, so you should always do your own due diligence before making any decisions. We're tracking these flows in real time, so while you're analyzing the next move, go check out the tools in the description. You can sign up for Public and get $20 in free assets, check out Webull for that BTC promo, or look into NVDA on Moomoo. All the links are right down below. And hey, make sure to like and subscribe for more deep dive analysis. Stay disciplined, stay liquid.